Hi guys, welcome to another episode of Finance Talk, where we speak about finance, business, and investing. I'm Eugene. I have more than 10 years of experience in business. I also interested in finance and building my own portfolio and hoping to set up a fund in the nearest future.
And I'm Nick Rational. I too have a lot of business experience and been doing the investing for a while now. Together, we're going to share with you what we have learned, and together we can all learn more and become greater investors. I too hope to start a fund in the near future, and let's all learn together.
So, what will be our today's topic, Nick?
We get asked sometimes, besides choosing a wonderful company, which is essential, and besides when the price is less than the value, and obviously buying on events helps a lot. But besides those things, how to get far better returns besides those things. So we're going to go through a list of things and we're going to discuss them and how they can improve your returns dramatically outside of the usual way of doing things. What do you think? Good topic, Eugene?
I think this is the great topic because our viewers need to know different methods of how you can actually earn money on the stock market. We are not talking about the gambling or the trading part. All this is connected to the value investing and actually intelligent investing as well. But in overall, you still need to think carefully and consider different outcomes, and investing in all the cases contains risk.
You must always buy only wonderful companies, and you must always buy them when the price is lower than the value. And if possible, you should do it with an event that you know why the price is low, the value is still there, you know it's going to bounce back. So always do these things. But the list of stuff we're going to discuss today is how to take your regular returns that you would get from doing that and how to make them even higher. Some of these points we've discussed in previous episodes. Some of them we'll discuss in future episodes. Point number one, we discussed very briefly, I think, in a previous episode, tax loss harvesting. All right. So that is when you have a stock in your portfolio. Maybe you've got 10 stocks in your portfolio, and one of them has gone down and just is never coming back up again. And you don't just sell those stocks, because when you sell is when you lose the money. So if it's down 90%, and you know it's never going to come back up, you don't sell it to get that little 10% back so that you can invest it. You leave it alone. You leave it sitting there at that 10%, not in the hope that it'll grow back, but you hold on to it for when you use it for tax loss harvesting. So how this works is when you finally do want to cash in one of your winners, and you want to take out that money and spend it on something, that's the moment you sell your loser. And that way, when tax time comes, you declare your profits on your winner and you declare your losses on the loser. And those losses offset those winnings and effectively lower the amount you pay in taxes and thereby increasing your return. So that is point number one. What are your thoughts on this one?
I think this is a really great technique which you can use in order to just decrease the amount of taxes you pay legally, and you do not need to buy anything else. You just need knowledge and understanding how to do it properly. I can add that you can also go and watch for particular laws in your country or specific state, if you are in the US, for how to receive like tax deductions for other options connected to the stock exchange and other expenses. Maybe this can be like the business expense or the expense for reinvesting your profits as the business. So, of course, there are different ways to do that, and you need to read about them and understand more carefully.
That's right. Expenses and deductions can be a wonderful way of increasing those returns, because when you pay taxes, that decreases your returns. So that's that one for that point. Let's move on to the next one. So the next one's very similar in some ways, and it's just important to bear in mind. So long-term capital gains tax. It sounds long and complicated, but it's actually really simple. In most countries, if you hold on to that stock and do nothing with it for over a year and 1 day, you'll find that the amount of tax you pay dramatically goes down. And that's what long-term capital gains tax is. They're rewarding you for holding on to that company and being a real investor long-term. What are your thoughts on this one?
Yeah, this is another really intelligent technique which you can use. And actually, if you a long-term investor, the government and the country actually motivates you to, as you said, hold the stock as much time as you possibly can. This can be a really great thing, which is not so risky. Both tax loss harvesting and decreasing long capital gains taxes are really easy to use stuff which everyone can do.
With long-term capital gains, effectively, is the difference. Like let's just take an example. If you have a salary of $200,000, or if you have earnings on your stock exchange account of $200,000, if it's within that same year, within the same 12 months, they're going to tax maybe even 40-50% of that money. They're going to just take it away from you. But if you're doing long-term capital gains, so you've held on to that stock for a year and a day, or if you're managing other people's money, the same tax rate applies. That goes from 40 or 50% down to 20% for most of human history. I think there's been some discussion recently of taking it up to 25%, but that's still a very far distance from taking half. So remember that you're a long-term investor. Generally, it plays out better to hold on to stocks for 1 to 3 years or longer. Famous investors have held on to the same stock for 10, 20, 30 years and done incredibly well with 10 baggers and 20 baggers. That's where your money goes up by 10, 20 times. So think long and hard about the tax implications of the moves you make in the stock market, and try and find a strategy that works for holding stock for long periods of time. Personally, I always look for an event that's going to hurt the price for at least a year. And that way I know that A, the price is going to be brilliant because all the short-term investors get out, and that lowers the price significantly. And then B, I know that when it recovers, more than a year will have passed, and I'm in long-term capital gains territory. Let's move on to the next topic. So all of the following ones are often considered more advanced strategies, but I thought we'd mention them anyway so that you're aware of them, and as you get to them, you'll have some idea of how they work. So the next one is called options, and it sounds terrifying. It does take a little bit to wrap your brain around. We don't do regular options trading as value investors. We do very safe options trading, and the way to know if it's safe or not is effectively you are only going to sell an option. You're never going to buy. And you're only going to sell an option that would represent a trade that you would have done if you weren't doing options. So you're gonna basically make a promise to buy a stock at a price you were always going to buy for anyway, and someone's going to pay you to do that. So that increases your returns significantly. And on the flip side, you're going to sell an option. So that was selling an option to buy at a price you were always going to buy, and then the other side, you're selling an option to sell your stock at a price you were always going to sell. And so long as you were always going to do those actions, options is effectively just getting free money for doing what you were always going to do. But make sure you're doing it right. Make sure you know what buttons you're pushing, and that the trade will go exactly as you think. Do paper trading for a while to get used to it. And on the flip side as well, you have to do the buying and selling in increments of 100 of that stock. So if it's a fairly cheap stock, you might be able to do it now. If it's a fairly expensive stock, you'll only be able to do it when you're a little bit more in the money. Most people can't afford to do Tesla stock at the current price in lots of 100. But you might be able to do Facebook stock. You might be able to do a smaller stock. It's not about the cap size, it's about the price that the stock is currently selling for. I don't want to get too much into it, but that's another strategy to increase your earnings by doing exactly what you would have done and getting paid to do it. What are your thoughts on that, Eugene?
Yeah, this is also a really interesting technique. And as you said previously, it's more for advanced investors because you not only need to buy 100 shares at once or make the contract to promise uh, buy such amount of shares, but you also need to understand at what price it would be better to buy or sell the stock. In this case, you need to understand the business, the logic behind the purchase, and it's not like the gambling. Besides that, the main advantage of such strategy is that you like the insurance company, so you selling the option to purchase these shares or sell these shares for the particular price, and you receive your payment in, which is called premium, instantly. So this can actually add you 10-15% annually for your investment, just understanding how to do it right. But of course, you need to be really sure and careful about what you're buying, because you need to find the companies. And as Nick said previously, we need to find great businesses which you really need and want to buy anyway at particular price.
What's amazing about that is that you still get paid even if you don't do the action. And so a lot of the time, for weeks, you can say, I'm willing to buy this at this price, and the next week it doesn't hit the price, so you don't have to buy the stock. You still got paid, and then you do it the following week. And every time you do it, you're lowering your basis. In other words, when you finally do buy, all those premiums count towards what you're actually ending up paying at the end of the day, which will be a far lower amount than what you actually pay, because you got to add in the amount that you've made in premium. So you're effectively buying stocks for far lower than their actual price if the transaction doesn't happen. And on the other side of it, when you sell it, same thing. If it doesn't hit the price, you still have the stock, but you've gotten paid. And then you do it the next week, you got paid. So when you finally sell, you add up all your premiums and the selling price, and you end up making a lot more money. It sounds wonderful, but make sure you know what you're doing. Paper trade for a while to make sure you know what you're doing. It is a little more complicated, but it is definitely a way to increase your returns. The next advanced sort of method is leverage. So this one, be careful of. Do not jump on this if you're a beginner. Maybe don't even jump on it if you're intermediate. This is kind of an advanced strategy. If you borrow money, let's just say I was buying into Facebook and I was buying just say 100 shares or $1,000, whatever it is you're doing. Now you've used your own money, but you're certain, very certain, to a high degree of certainty that this is a great investment, and you can borrow money at a very low amount. Let's just say that you're able to borrow at 3%. Now, that might sound strange to some of you because you're all used to credit cards, but when you're an investor, your broker will often lend you money with your portfolio as collateral. And they're so certain that you're zero risk because of the collateral that they'll give you a much lower interest rate. So when you're going to a credit card company, they got no guarantees you're going to pay them back. So they give you like a 21% or 25% interest rate. But with margin, that's what they call it, when you borrow against your portfolio, they're so sure you're going to pay them back that they'll give you a low interest rate, like 3%. Now, if you're sure it's a great investment, and this is very risky, but if your certainty is high, you can borrow money, sometimes a quarter of your portfolio, sometimes more, sometimes less, at just 3% a year. You don't ever have to pay back the collateral so long as you make those 3% payments forever if you want. 3% is almost nothing. So effectively, it is an advanced strategy. You need to be very certain that your stocks aren't going to suddenly halve, because if it does, the ratios will be out and your broker will call money from you. And if you don't have that money in the bank to fix those ratios, pay off some of the debt, get the ratio right between the size of your portfolio and the amount you borrowed, if you don't have that cash to fix that problem, they will sell some of your stock to fix that problem. And it'll be selling at a time that the stock's very low. So that's where the risk is. If your stock suddenly goes very deep down and the ratio is wrong, that could hurt you big time, because now they're selling your stock at a very low price, or you've got to suddenly put money from your bank accounts to fix that ratio. But if you're certain about the stocks you're in, that they're not going to go down, the benefit, and this is what this episode's all about, is where how to get your returns higher. If you know what you're doing, one strategy, borrowing that money at 3%, putting it into a stock you know is going to shoot to the moon, or even just double in a 3-year period, you're effectively going to double the money you've borrowed. And that really improves your returns. And you're only paying 3% on that money. So if you're getting a 26% return on your money per year or something, that's a phenomenal extra growth you can have. It is risky. There have been hedge funds that have over leveraged themselves and gone bankrupt because of it. So this is an advanced strategy, but it is a great way to get better returns. What are your thoughts on that?
I agree that this is an advanced strategy, and personally, I do not use this strategy at all. I think that we, as value investors, cannot project what will be with the market and with the stock in the nearest future. And personally, I'm, as the long-term investor, can be right about the stock for 3-5 year period, that it can grow in 2x, 5x, 10x, etc. But I can be wrong for this particular company and the stock in the short term, which means that due to all these stock and price fluctuations, the stock can easily drop down like 40-50%. And if you do not know what you are doing, and this one of your primary revenue streams, you can be really hurt from that. And as Nick said, this is really advanced strategy. I personally um, do not recommend to do that. But if you are certain and if you are really know what you're doing, probably this can be also worth considering. This is the end of this episode, guys. We will continue next time. And if you have any questions, please write them down in the comments below. And see you next episode.